Welcome to Trader TV. I'm Dan Barnes. With me today is Anish Puaar, European Market Structure Analyst at Rosenblatt Securities. Anish, welcome to Trader TV.
Hi Dan, thanks for having me.
So we're going to discuss what's been happening in the equity markets over March, that period of volatility. Just to start with, how would you characterise liquidity and trading flows during that very volatile period?
I think the first thing to say is that markets actually held up very well, despite seeing very, very high levels of volatility. I'm not sure if they were the highest ever, but definitely the highest ever since the introduction of MiFID I and fragmentation of equity trading. So we saw days where trading volumes were double what they normally were, and we didn't see any market outages or anything that would have affected people's ability to get in and out of positions. The other thing worth saying is that liquidity providers and market makers seem to be present during those high periods of volatility. So often a criticism leveled at some market making firms or liquidity providers, whatever you want to call them, are that in times of market stress, they disappear. And given the volumes we saw, that didn't appear to happen. So we would have seen spreads widen slightly, which you would expect in a very volatile market, but liquidity was there and available for investors to get in or probably out of positions during that time.
During that period of volatility in March, where did you see trading taking place most?
Mid-March, when the volatility was at its peak, you saw lit exchanges and lit MTFs like CBOE and Turquoise gain a little bit of market share over the likes of dark venues and block venues, where typically you need to rest orders in there to find a match. And when prices are swinging kind of all over the place, you might be less willing to rest orders in those kinds of markets. And equally, you might be less willing to wait to the end of the day and trade in the closing auction. So another effect we saw during that period was a reduction in closing auction activity. Another effect was a reduction in SI or systematic internalizer activities. A lot of that activity comes from banks' central risk books. And again, during those volatile periods, banks might be less willing to hold themselves out there for capital commitment or risk type trades, which would have contributed to a lower SI market share.
Aside from the actual sell-off itself, what other factors have been impacting liquidity over the last month or so?
One of the main talking points over the last month or so is the short selling ban, which was enacted in various European countries over the last couple of months. Those bans ended on the 18th of May, but it had an impact on liquidity. And perhaps if you look at some hedge funds, for example, who have strategies like pair strategies or offset strategies that rely on a lot of short selling within them, those strategies may have not been possible and would have affected liquidity, particularly perhaps on multilateral trading facilities, so alternative venues to domestic stock exchanges. Hedge funds typically prefer those venues because of the lower execution fees compared to exchanges. So you could have seen an outsized impact on MTFs losing market share during those short selling bans. So it'll be interesting to see whether the MTF market share picks back up again, but it definitely sank to new lows during March and April. It's also interesting that many markets, including the UK and the US, decided not to implement short selling bans because they didn't see as much of a problem with it compared to other European countries like Italy and Greece.
Yeah, well, from memory, I remember Greece and Italy having been quite severe on short selling bans back in sort of 2011, 2012 as well. So historically, they seem to have been quite down on the process.
Yeah, and France as well, which is another one I should have mentioned. And those regulations were introduced in the wake of the 2008 crisis, where many European member states took unilateral action to ban short selling in their own countries, which led to a bit of a disjointed process across the whole of Europe. A lot of market participants, including hedge funds and exchanges via the World Federation of Exchanges, for example, have spoken out against short selling bans and have been quick to note that short selling is a legitimate risk management practice and something that helps to keep prices in line.
So looking forwards, what are going to be the dynamics that affect market structure over the next few months to year?
Before the pandemic, there were a couple of consultations from ESMA and the European Commission about reviewing MiFID II. So both focused on slightly different things. So ESMA was focused on equity market transparency, so that covered trading venues, dark pools, periodic auctions, systematic internalizers, and to some extent the consolidated tape. But the Commission consultation was broader, but had a big focus on the consolidated tape. The ESMA consultation included some quite radical proposals, so things like more restrictions on dark pools, more restrictions on periodic auctions, more restrictions on systematic internalizers. So what was interesting to me is that in those responses, you saw, broad buy-side support for having a variety of trading venues. Buy-side saying that we like dark pools, we like SIs, they all provide a useful addition to the ecosystem of markets that we have available. They help us to manage market impact and ultimately help us get the best results for our clients. So it's going to be interesting to me to see the extent to which ESMA and the Commission, when they come to reviewing MiFID II, take those comments on board. What we saw when MiFID II was being negotiated, almost a decade ago now, was the buy side taking quite a similar stance, so voicing their support for things like broker crossing networks and for dark pools. But, in my opinion, the regulators didn't really seem to take that on board and ban broker crossing networks and impose quite strict limits on dark pools.
Yeah.
And then on the consolidated tape, that's a debate that's been running on for over a decade now, ever since, MiFID I came into force in 2007. Yep. So, a lot of market participants will be hoping that we can come to a solution on that and that something does get created. But there is still quite a wide divergence of opinion. The exchanges, for example, preferring an end-of-day tape of record, and other participants, including brokers and some buy-side firms, really wanting a real-time pre-trade and post-trade consolidated tape.
Anish, thanks very much.
Thank you, Dan.
I'd like to thank Anish Puaar for his expertise in this show, and of course you for watching. To catch up on our other shows, go to tradertv.net or etftv.net.